Hey everybody, this is Jose Blasco. Sound check before we get started. I was having a little issue with connecting my sound, but all should be good now. Can I have a quick message on the chat box as always? So I know you guys hear me well. That way I know we are ready to get started. I'll turn on my video stream here as well, so I can position myself as always in the bottom right side of the corner of the screen, so you guys can see the charts and everything else, and at the same time we can be connected. Thank you, Joe. Thank you for confirming that. Very good. So now I know all is good. Perfect. Let's get started, everybody. Welcome, everybody, to the session. Today is November 17, 2021. My name is Jose Blasco. This is Options with Options. So what we do is to trade options. I guess it's pretty obvious. Before we get started, we have the disclaimer on the upper left side of the screen. Please read it carefully. This is important information. Read it completely. Do not skip it. It's important stuff. That's why I am highlighting it. So I'm counting on you to read it completely. Thank you so much, guys. Clive, how are you? Mark, good to see you as well. Very nice. So agenda for today, as always, the structure. We're going to be looking at the market first, understand what's happening out there. From there, we'll look into trade review, trade management, trades that we have running at the moment, what to do with those trades. Is there any action we need to take to make sure those trades do what they're supposed to do? And finally, normally the most important or interesting portion of the session is when we are looking for new opportunities to be added to our accounts and either use them with real capital, paper money, larger size, smaller size. All of this depends on you. But indeed, the plan is to plan those trades in a proper way by following our rule set. Okay. Ahmed, good to see you. Joanne, good to see you as well. Wonderful. So let's get started, everybody. Very quick comment here. We've been talking about our question page located in tradewithufos.com/Jose. We've also been talking about how we had some tech issues, when it comes to posting questions. I just wanted to share with everyone that this has been fixed. You can see that the bottom part of the question section looks a bit different. It's actually simpler and nicer now, I would say. And some of you already started posting, by the way. So thank you so much, guys, for being engaged and for also for sharing your questions with the community as this is helping everybody. So just keep in mind that URL if you have any questions, so you can post it easily and consult on prior questions as well if you have any question. Mario, good to see you, my friend. And apart from this, also I wanted to comment on our app section on the website very quick. So many of you realize that the platform that we use in every time really, but especially with the option sessions, the platform that we use is quite powerful. We call it Top. For the ones of you never seen it before, it's a predictive options planner. And some of you may wonder how to subscribe so you can use it. So you can see here the direct link on the app section of our website, tradewithufos.com/apps. You just click on the drop-down menu for a Predictive Options Planner, and then you select either yearly or monthly, depending on what it's best for you when it comes to a subscription model. Okay, cool. Okay, so with all this said, let's jump into the charts. We have some analysis to be done, and let's begin. Okay, so where are we at? Well, the S&P changed climate a few days ago after spending 2 red dots in what a normal down climate is based on statistics. So in this case, we didn't have a surprise. Okay, we were coming from multiple, strange behaviors of the market, strange statistically speaking, in the sense that down climates are supposed to last for 2 candles, and it was a very, very long climate here and here to the downside. And up climates are supposed to last for 6 candles, and we had a very lengthy up climate that took place, with this incredible move to the upside. Okay. Having said that, we got the pause we needed for everything to restabilize, and we are back to an up climate. This is day 3 in this up climate. I'm sure you guys were following and you are aware of this. This is candle 3 into what I just said, an up climate, could be, 6 candles. Okay. Now, little note of caution, and I guess I'm not the only one perceiving that. Little note of caution: when up climates are taking place, typically if the price stretches 0.77 ATRs above the EMA or more, that would be a 2 standard deviation of cases. So that typically leads to soon later a change of climate. And in this case, not currently. Currently, we are dealing with 0.66, which is less than 0.77. But we've got a case in this climate, which was, the day before, where we reached a peak of 101. Okay, and again, so while the climate is still supposed to last for 3 more candles, indeed, there is a component in this up climate that has been a bit too aggressive to the upside. And again, if you compare, this high with the highs that we had in the prior climate, that's nothing. Again, the prior climate was really unique, very strange from a statistical point of view. So the climate could certainly continue, but here's the note of caution. The note of caution is that the put implied volatility is greater than the call implied volatility. Okay, so that's why I made this comment a moment ago. I said someone may be looking at this. Okay, someone may be realizing this, and it seems that there is a lot of put buying or call selling, which in both cases, both are a bearish action, and therefore there is a little bit of a bearish component kicking in from behind the scenes. So what to do when we have a climate like that? Well, again, the climate is confirmed to be up. So this is our main guide. Okay, so when building a portfolio, I'd rather be more positioned more strongly with positive deltas than negative deltas, because the climate in the S&P is blue and is confirmed. But having said that, what I wouldn't want to have is a portfolio where absolutely everything is to the long side, because as you can see, this is a little bit of a note of caution, together with the fact that we went to 101, which is greater than 0.77. Okay, so in other words, I would not say, just like I was saying the prior week or the week before, for every long I want a short. I would not say that, but definitely, a little bit of negative delta in the portfolio would be healthy, just in case that increased volatility on the options actually will translate in price movement to the downside, and you were too loaded on long trades with positive delta, that then next thing you know, they are all working against you, and that would be a bit too painful to sustain, isn't it? Now, when it comes to UFOs, notice that we have UFOs below price, not too far. So again, if the market was to fall, I would not see a major crash happening, unless something really strong is happening fundamentally. All those unfilled orders get canceled. The normal thing would be to see what we are seeing now, that the market gap down, scaring people, but then just hit a UFO, and from there what happens is moving back up. Okay, so that's probably the what we're gonna see, and that's why I'm giving more importance to the climate compared to what we see on the options arena. Because again, the climate is our main guide, as I said a moment ago. Okay, but again, we may have now price reach that red UFO and fall to the next green UFO until finally price stabilizes and go back higher. Okay, so this is 465, which is just a little below the EMA. Also, the EMA has an M built in the acronym, which means moving, which means that value of 466 moves. So if the S&P goes down, that 466 may become 465, which means that EMA is now lining up with a UFO, and next thing you know, we have a beautiful turning point. But it may imply for the market to move aggressively down, and that may be the reason for that increase in implied volatility for the puts, because some professional traders are anticipating those UFOs to bring the prices down. It doesn't mean a change of climate is going to take place, but maybe there is some movement to the downside for a day or two. Within, we are still in a blue confirmed climate to the upside. Okay, and then that below UFO end up being a beautiful entry point for a directional trade to the upside. So again, not a major risk, just a little note of caution there when it comes to not being only bullish and having a little bit of a hedge to the downside. So looking at the options volume map, we can also see that nothing is too relevant. So you have 1.5 times more calls than puts. Okay, you would say, well, that's more relevant, or 1.7 with that November 26 expiration date. You may say it's relevant, and you know what, it is. But the reality is that the volume is below the average. Okay, the volume is below the average, so it's not that relevant. Okay, so again, nothing. It's clearly telling us the market is really gonna crash, or the market is really gonna rally. There is a little bit of a fight going on, which it's probably the normal consequence of that selling pressure as well as the buying pressure below, because this buying pressure here, kind of already did what it's supposed to do, which is creating this bounce. So we may need the S&P to go a bit lower to bounce from the next UFO. Okay, so all within normality, and definitely we should be able to find opportunities. Again, I'll start with longs, okay, because of the climate, but certainly I'd love to find some shorting opportunity as well, just to go through the process so you guys can replicate that for yourselves. Okay, Christian, good to see you. A bit of fear before Santa Claus rally, yes, and apart from fear, also probably a lot of profit taking. Let's face it, many people took profits here, and that profit taking probably created that move to the downside. So now that the market is reaching those same highs around 470, so probably the people that did not take profit, they realize there may be a resistance level there, if I was to use the terminology of technical analysts, and probably some people are having second thoughts now and taking profits now because they didn't need before. And there are sell-on field orders in the market. You can see that the UFOs are there, right? So that's there. We gotta respect it, but at the same time, remember, in an up climate, sell-on field orders tend to be canceled. So just like there is fear, okay, just like there is fear, there is also greed. And as the market has been falling, that created fear. Probably the reason why the implied volatility on the puts went up. But as the market rallies, if any of those on-field orders get taken out, because that's what tends to happen in an up climate, where sell on-field orders tend to be canceled and buy on-field orders tend to be added. So if those get taken out, next thing you know, you're gonna see how fear becomes greed, and that implied volatility for the calls is gonna go above the implied volatility for the puts, and it's just this beautiful game that is being played behind the scenes, if you wish, and it's fun to observe. Okay, so anyway. So that's the market condition we have. How does this translate to the implied volatility of the options? So let's take a look at the VIX. Well, it's easy to imagine, okay, if we are back to being an up climate, so obviously the implied volatility is showing lesser than what we had last week at some point when the market was in a red condition, in a down climate condition. So we are dealing with 16 point something VIX, which is not amazing, but is not that low either. Okay, so certainly non-directional trades would be more than welcome too, but probably given what I said at the beginning of the market analysis, and given the fact that for once, okay, for after 2 weeks of waiting, we have a defined climate. Not only is defined, it's within the realm of possibilities indicated by probabilities. So we have a healthy environment to be directional. So for sure, nothing wrong, and you should always be thinking of what about adding some non-directional trades, because they pay you theta, isn't it? They also create negative vega. We talked about this before, so for sure. But my focus today is going to be directional. Okay, cool. So now let's move into reviewing our trades. Okay, and the first one is we need to review KBH, even though there is very little for us to comment on KBH. So KBH, let me float this window. So KBH. Okay, this was a hedging trade that we entered that didn't do anything for us. Okay, actually, it went all the way. If you look at the graph, it's almost like a joke, right? Because we entered here and it went all the way in the opposite direction. Okay, so it's almost like we were, the ones who created the complete change in direction of that stock. Timing is everything, like everything in life, right? So anyway, so that hedging trade didn't work well at all. It didn't not only hedge, it's actually creating a loss, isn't it? But again, we've been massaging this trade where if we did nothing, the loss would be $180. Thanks to what we did, the current level of loss is 155. The most this trade can lose is actually less than that, I believe it was. Let me see if I'm correct or not, because it's many trades, so I may be confused. But I'm looking at a risk graph for this trade, and we're going to be able to see the maximum risk. Well, actually, the maximum risk is 165, so I got that wrong. Again, what we did with this trade is that we gave it a second chance, meaning that now we had two puts instead of one. So if the market was going to fall, then that would pay very nicely, but the market didn't fall, and it's an up climate. So the expiration date is November 19, which is tomorrow. So this trade is very, very likely going to end up like that, which is a loss of $165. And that's what it is. In the meantime, again, we made some money with Pfizer, with this, with that. So not a big deal. But obviously, we are now reaching the end of the life of this trade tomorrow. Sorry, not tomorrow, on Friday. And that would be basically the end of the story. Okay. So COF, okay, COF is a trade where we may have some work and some analysis to be done. Okay, so let me go ahead and update all those things. So with COF, when we enter this trade, if we did nothing, this trade would be making $55. Okay, now we did some conversions here, as you can see. Okay, there is a lot of stuff going on here. Okay, and this trade is currently making 85 net. Okay, so if you look at Think or Swim and you look at COF, it shows $31. Okay, it doesn't show 80 plus. But the reason why is because on the account, the only thing we have now is a bull call spread, which is buying the 174 call and selling the 179 call. So that's the only thing left, which is currently producing $31. But overall, when you add the prior trades that we closed, the prior units that we closed from the original trade, where we had puts, okay, everything started because we sold two puts, actually two bull put spreads, I should say, and then we bought a call thanks to the premium. So thanks to all those conversions, notice the beauty of working on this trade management and why I spend a lot of time, especially on the Wednesdays, is because now not only we have converted in the past losing trades into less of a loss or profits. In this case, what we see is a trade that should be performing at a level of 54. Well, this trade is now performing at the level of 84. Okay, so we are again working on trying to improve those rewards to risk ratios. Okay, which is also something I would like to explore with Yelp in a moment, because this is also a trade that we took last week and this is working well, but we need to see if something needs to be done. Okay, but first things first. Okay, first things first. So let's talk about this trade that we currently have with COF. So let's take a look at COF. I believe this was a trade that was initiated on the 3-day time frame, if I'm remembering well. Yes, it is. Okay, so this vertical line here, okay, represents the day we took the trade. Okay, so the trade was taken at this moment in time. The stock started working in our favor. Every one of those candles is 3 days. Okay, the stock started working in our favor. That's when we did the tweak, and then now the stock has been going a little bit against, and now today the stock is up 0.47%. Okay, so all is within normality, but thanks to the initial move up for a few days, we were able to remove the risk of the trade, reconvert this trade, and now the stock has been moving lower. Of course, our bull call spread is performing better than if it was just a call. Okay, so you can see all of that in the screen before, and now when you see the chart, hopefully this is well understood. Feel free to ask questions if that's not the case. So what else can we do when looking at this trade? Okay, what else can we do when looking at this trade? Did I keep somewhere the location for the target? Let's see. I believe so. We are dealing with 174, 179. Yes. So I think that when we planned this trade, our original plan was to use that second UFO as a target around 175. If I'm not mistaken, that was the plan. Now, while that was the plan when we entered the trade, even though it's very subtle on the 3-day time frame, okay, it's very subtle on the 3-day time frame, but there is a little bit of a turning point there, where if you look at it on the daily time frame, we can see it very clearly here. Okay, so now on top of that, we can see how we just changed climate. Okay, and on top of that, I did mention that there is a little bit of risk coming in on the S&P, minor, but a little bit. So one thing I like to do, okay, is to be a little proactive here and look at this high that was created and just project, if price was to go above this high, how far we would expect that market to go. And in this case, we are looking at 161. Okay, 161 would be a more, let's call it, achievable target, 161. Where again, if I go back to my 2D time frame, where we said we would take profits at 175. So notice that it's looking like maybe 175. It's a bit far. Okay, it may be a bit far. Okay, given the fact that we have a speed bump here, and if price rallies and comebacks here, the speed bump is likely going to generate a significant turning point. Remember, those speed bumps are typically generating significant turning points. Okay, not only a turning point. but significant. So all of that is going to make it very difficult to obtain the 175 mark. And also on top of that, we have another UFO below, which is going to make it even tougher to get to the upper one. Not too concerned of that UFO because remember, in a Nov climate, sell on-field orders tend to be canceled. So I'm not super concerned, but I am concerned about that speed bump because that speed bump represents a potential significant turning point. Okay, so that's concerning. So therefore, I would like to reevaluate this trade, thinking that okay, if instead of shooting for 175 as target, if I was to shoot for a closer target at 161, what can I do? Is there anything I can do to lock in more profits? I am actually making more profits than the original trade. So can I do it again somehow and reduce more the risk and lock in more profits? That's the question. Okay, that's the question. And to answer the question, I'm going to have to look at a risk graph and get to understand better, my various what-if scenarios. Okay, so if I get to 161, let me get the, here we go, the data window. So if I get to 161, which is more or less here, okay, so if I get there today, okay, I'm gonna make $120. Okay, this is what I would make if I was to get to the target today. Of course, if I was to get to 175, much more. But now the assumption is I may not get there, okay, because of that turning point that took place on the daily time frame, which is an obvious one, creating a new speed bump. So that may make it difficult for us to get there. So what if that's the case, okay, and we don't get there and we only get to 161? So then the profit of the trade would be 120. So can I find other types of trades that would, can I convert this current trade into something else that would make me around 120, okay, or more, or rise my worst case scenario? Not is my worst case scenario, okay, my worst case, if I put my mouse anywhere, okay, like if I put my mouse, let's say the stock drops all the way to 115, so my worst case scenario is to make $26. That's my worst case scenario, okay, because thanks to the conversions that we have made, in my case, and I remember some of you did it better than me, so some of you locked in more, but in my case, I locked in $26. So I cannot lose. Worst case, I'm going to make 26, okay? But can I raise that and give this trade an opportunity to make more if I reach 161 or at least make the same? If I can make the same and on top of that, make more if the stock is trading at a different price at 161, so then I would certainly take it, okay? And what kind of approach can we use? Well, if you are not guessing it, okay, let me ask you, anyone guesses it? Remember, even though we have many rows here, all of this really is a bull call spread, okay? So what can we do to a bull call spread to reduce its risk? Okay, let's see if you guys are with me on that. And in the meantime, I have a few missing comments and questions there. Let me read that, okay? Joe, SPX and VIX options begin trading round the clock next week. Yes, indeed. So it's kind of like they become like the futures options, isn't it? Yes. Nice one. Christian, you're not in the CF. Okay, got you. Butterfly it. Very good, Christian. Good one. Good one. So again, in this particular moment, okay, we are short, okay, the 179.4 call, and we are long the 174.4 call. That's what we have. That's our bull call spread. Okay, that's our bull call spread. But doing an iron condor, it's indeed an option, Mark, but it would imply many things, because first, now we need to get calls above the 179. So that means that we need to sell we need to close the 174. So I will need to do a lot of conversions. Plus, I would change the bias of the trade from directional to non-directional, which I'm still directional. Remember, that stock, COF, belongs to a strong industry, all of those things. So I'm still directional, okay? So I don't want to lose that component. So then butterflying it is going to be a better choice, where I could go ahead and sell another 179.4, okay? And then above that, at the same distance, okay, I could buy what would be the 184.4 call, and that would now become a directional butterfly. And I may even play with changing the distance between those strikes to see what I can accomplish with that, okay? Anyway, so let's see if that is doable and this produces the desired result. Now, how can I do that? I'm going to compare spreads. And the thing is that I got already many rows, 2, 4, 6. I need to add 2 more rows. 1 and 2, very good. So I just added 2 more rows. And the 2 more rows I'm going to add. Okay, and again, I got so many rows because I am basically dragging into the future everything I've done before, okay? But the reality is that the end result is going to be 4 units, okay? So I can go ahead and sell and buy. So you would be selling the 179 and you would be buying the 184.4. Okay, so notice, let me zoom in. So sell the 179 and notice I selected mid price, so it's going to be real-time price, and buy the 184, also mid price, so it's going to be real-time price. Okay, so if I do that and I click OK, that's going to give me 2 risk profiles and compare the difference between the 2 of them. So then I can evaluate what's best for me. Okay. Now, notice if I butterfly it, okay, the worst case, which is reaching all the way expiration, which is in January 21st, 2022, now I'm going to make 58, which is more than 26. Okay, 26 in blue, 58 in red. Okay, so that's good. And then the second one is, what if I reach to 161? Okay, which is right here, somewhere here. Okay, so now here's the penalty I have to pay. Okay, here's the penalty. I would make only 88 instead of 120. So I would make a little less if I reach that target. Okay, now the current price of the stock is 154, and that simulation is for you reaching the target today on 11/17. Is it likely for us to reach 161 today? Well, I would say probably not. So what if we do an estimation of a date? If I send this to the strategy builder, 160.97, it's telling me the target date is supposed to be on December 8. So that's a very good estimation for date, December 8. So what if I simulate my spreads moving my date, okay, to be December 8? Okay, so if I do December 8, okay, and I go back to 161, more or less here, good enough. So now you can see how my butterfly is going to still do something very similar on December 8. If I reach my target at 161.09, I'm going to be making the still $88. So it's about the same. I'm not gaining much more performance. But notice how the bull call spread is likely going to lose performance because of time passing and the effect of time decay. So, and if I was to take a bit more time than December 8, so next thing you know, now we may be making the same amount of money, okay? But the one thing that is a sure thing is that if the stock, goes to the moon and the stock drops all the way to 0, so now my butterfly would make 59 instead of 26, okay? So to me, it's a good idea to go ahead and do this conversion. Okay, it's a good idea to go ahead and do this conversion because you put yourself at a little bit of a better advantage. Okay, now the one thing I'm not too happy about is the fact that COF is not the most liquid stock in the world. If you look at the bid and the ask, okay, if we look at the bid and the ask, so the bid is 87, the ask is 106. Okay, the bid is 55, the ask is 72. So in other words, let's say you reach that target at 161 tomorrow and you want to get out. You may need to suffer slippage now in 4 units instead of 2. Okay, so yeah, fair enough. If you leave it all the way to expiration and you don't even do anything, you just let it all expire, you won't pay commissions, and now you make 59 instead of 26. That I like it. But if you're gonna enter and exit and you are not careful with those spreads, you may get hurt. Okay. Also, those spreads are not the best in the world because, to be honest, those strikes are so far away. Okay, those strikes are very far away. Remember, that stock is currently trading at 154. So those units are 170 and 184. So the day you get to the target, things would be better from a liquidity standpoint because you would be closer to at the money. Okay, and then everything would look better from a liquidity. So in other words, I'm still looking at this tweak as a valid tweak, a smart approach to improving the trade, but I want to make sure I get filled at a very, very first fair price. So this is something that I would do it using multiple days. So I would just place the order today, like exactly at the midpoint. Okay, with I would do this. Okay, so I would just go ahead and let me do it like this, just so, because that way we have all on the screen. So I would just go ahead and let me get rid of everything. Let me make this to be mid. Let me add one more, which is buy 184. Okay, so for you to butterfly it, you need to do this. You need to sell one of the 179s and buy one of the 184. Okay, and if you do that, okay, currently, how come? Yes. So actually, you may end up getting filled more efficiently than what I thought. Okay, it seems that the net midpoint, if you do it as a spread, is actually more convenient than what I thought. But again, per contract, there is there is not the best liquidity in the world. Okay, so in this sense, you would want to take it very, very easy, place an order exactly at the midpoint, and just wait. And if you get filled, great. And if you don't get filled, do it again the next day. And not to rush into doing this at all, because if you rush into doing this, then it won't be worth it, because then on the way out you may suffer slippage, on the way in you suffer slippage, and then it's not worth it. Okay, so again, take it very easy, do it very carefully given the levels of liquidity of COF. But if you do get a good price, then indeed it's worth it. So I'm just gonna go ahead and do it. You guys, please go ahead and feel free to take screenshots if you need. Feel free to type questions about this trade if you have, because this is the time. So we are using January 21. I'm just going to be selling. By the way, another way to I often get here into sell, vertical or whatever, and sometimes I will then make it custom as in it. So sell vertical, and then you come here, you make it custom, and you can do anything you want. Another way to do your trades with TOS, which you may or may not know, is that you can just load a much longer list, so you have all the options you need on the screen. And in this case, we need the 174 where you need to sell, so that's the bid price. So we can do is click on the first one, okay, and that gives you one, okay, so selling the 174, and then I want to buy. Sorry, it's not the 174, it's the 179. I clicked on the wrong one, sorry for that. So sell one of the 79, and then I wanted to buy the 184. So now what you can do is just click on that one as you keep the control key on your keyboard held, and then it's going to add it down here, and automatically it's going to call it whatever name that spread combination has. But I basically did it by clicking instead of having to find my strikes in the drop-down menu. If you prefer to do it this way, just a little tip there on how maybe to be a bit faster. Okay, so here it says 37 cents. Again, in the demo account, I'll just do with whatever it is, because I just want to get it filled so I can demonstrate for you in future sessions. But again, as you are doing that in your real accounts with real capital, just be picky, my friends. And remember, there is no rush to do this. We're just improving the trade. This trade cannot lose anymore, so there is no rush on doing it. Just have your asking price there at 37, 38. Even if you want to go 40, just place it there, wait. If the stock rallies, you may get 40, and if not, do it again tomorrow. And if it rallies, 2 weeks from now, then you do it then. Okay, but don't do this for cheap, or don't do this as you suffer slippage. Okay, that's my point. So I'm just gonna place the order, and we have it in waiting to get filled there, 36.5, 36. So I'll just wait and review this before the session is over. Okay. Christian, commissions are normally not a drag unless your broker is charging you too much. The advantages you just gained there, I mean, you just, instead of making 26, you're going to make 58. And in order to do that, you pay the cost of 2 contracts, which may be 50 cents, 60 cents per contract. So, I mean, commissions are not a drag. I mean, they are a cost of doing business, but I would not call it a drag. unless you are doing this with a very, very cheap stock, and it's not really helping that much. Okay, so it's not only, you may be thinking, I'm getting 37 cents and then I pay $2 or whatever, but again, it's not about that. It's about the net result that you see on the risk profile, which in this case, if I go back to the orange one, so you go, in this case, I guess the stock went up a little higher. In this case, you will get $63 of profit instead of 26. So that difference, those $40 extra, almost $40 extra, definitely pay for those extra commissions. Okay, cool. Okay, so I'm gonna float this one to get it somewhere else. Okay, and I'll come back to this there later to copy, okay, and paste that particular position. Going back to the positions, okay, the next trade I want to discuss is Yelp. And to be honest, the conversation we're about to have is very similar, because Yelp, which is a trade that we planned the other day, and I believe we planned it using the 89-minute time frame. I believe that was the plan. Okay, so it's loading. So Yelp is also, as you can see, it's a bull call spread where we are long the 35 call and we are short the 43 call. Okay, that's what we have with this particular trade. So what is Yelp doing at this moment in time? Where Yelp, we entered the trade on that particular day. That's the day when we entered the trade, and that stock has been challenging a little bit. If you've been watching, when your way, you're like yes, then it went against you, then it's no, then now it's pushing hard, then it's yes. Good news is that, and the prior day we changed climate, even though it's not confirmed, we can still see a little bit the puts kicking in. Okay, so that produces a little bit of concern that the puts are still winning against the calls, and the fact that the climate change is only a change from red to blue, but it's not a thick dot, it's not a confirmed climate, it's unconfirmed. So, because of that, obviously it's not the best scenario to trust the trade all the way. But having said that, it's indeed now pushing a bit harder. So tomorrow we may have a confirmed climate. So in any case, I want to evaluate this trade using the risk profile and see, what is it that we have in our hands. So this trade currently is making $37.50. On the TOS platform, we have it here. It shows us plus 40. Again, all of those are the various fluctuations, that have to do with the bid and the ask spread and all those things. But anyway, so the stock is moving our way, so the spread is paying as planned, right? So that's good. But now the question is, can we do anything to make it better, right? And that implies a little bit of extra analysis on the chart. So I would like to look at, and I guess I did not document this the way I normally do, which is normally I would set where my target would be, isn't it? But in this case, I didn't set where the target would be. To be honest, I totally forgot what was the location for the target. Anyone guys remember what was the location for the target? I guess I didn't make a note of it, and that's my bad. I'm sure that someone made a note. You guys are amazing at just keeping notes and learning and practicing. So I'm sure if anyone could share with me, so I don't need to do the whole reanalysis again, that would be great. Even though I believe probably the analysis had us look at this high, and probably we projected, and we are probably looking at a target around 42.8. I think that would probably be the case. 42.8 is probably where the target would be. But again, looking forward to hear from you guys if that's the case, that you have the notes. Now, if we did nothing about this trade and we reach that 42 point something target, so this trade is going to make 42.8 more or less here. So this trade is going to make up to $426 if it was to happen today, 188, okay? Because, we are above the theta switch point, and this is a pretty unique situation. 42.75. Thank you for that, Mark. I knew you guys would have it. Thank you so much. So yeah, I guess it's what I got there on the screen. I said 42.8, probably with a bit more precision with my mouse, it would be 42.75. So now this is a pretty unique scenario because we are above the theta switch point, which is when you look at a spread, a bull call spread, you have two strikes, and you look at what's the midpoint between 43 and 35, okay? Which from 35 to 43, we got $8. So the midpoint is 4, and 35 and 4 is 39. So in other words, because we are above 39, which is 39.26, so we are now enjoying a positive theta situation, even though it's a debit strategy. Okay, so even though it's a debit strategy, we have a positive theta where, if that stock was to reach the target, but instead of reaching it today, it reaches it sometime in the future. So instead of making 188 today, you're gonna make 426 in the future if that happens all the way on the expiration date. So theta helps you as long as the stock goes up. But what if the stock goes down? Well, if the stock goes down, of course, now you can lose up to 355, which is the cost of the spread. And on top of that, below 39, now on top of that, theta is hurting you. So since we surpassed that theta switch point, and the stock now seems to be showing some directional component, for sure, it looks like we're going to start making money to the upside, and probably it's too soon to do any tweak, especially this trade is using February 18 expiration, because 42.75 is relatively far, and our target date estimation was bringing us to use expiration dates of February, also because we are lining this up with the next earnings date. But anyway, so I'm going to explore it because that's our job, explore if any tweak could be beneficial. But I would think, unless I'm wrong, that in this case, probably it's just a bit too soon, to do that, okay? So now, what's the way to improve this type of directional trade? Well, you just saw it a moment ago with COF. You can go from a bull call spread into a call butterfly, which is a directional play as well. And the way to do it would be by adding a couple more legs, where one, you would sell another one of the 43, and then above, we want to buy a call at the same distance, which we said is $8 above. So that would be 51, which it does not exist. So I'm going to go for 50, okay? So what would the risk profile be if we were to do this second trade? Well, let me tell you, I'm not going to recommend to do it. That's what I said. I thought it was too soon, and indeed it's too soon. Why? Because if we do that, from a risk point of view, we go from a $355 risk to a $220 risk. That's fine. But here's what really bothers me. With the blue risk graph, which is our current trade, the higher it goes, the more you make until you reach your limit, which is 445. But the higher it goes, the better it doesn't hurt you. Where with this butterfly, because the stock hasn't rallied enough yet for us to do the tweak, notice how there is a portion where above this price level, which is 48.62, okay, you have it here, break even. Above this, now you start losing money if the stock rallies more. So in other words, let's say that stock gaps 20% up in one day. There is some news and the stock gaps 20% up in one day. So now you're in pain. Instead of being directional and now enjoy that 20% gap up, now you are in a problematic situation. And it's all because doing this conversion now, it's too soon. The reality is that the probabilities of the stock to gap 20% up in one day is very low, but it happens. Not too often, but it happens. And if it happens now, it's probably one of the most frustrating situations of all, which is you are crazy right on direction, like amazingly right, and now you lose. Okay, so I personally don't enjoy that, and therefore I would not want to expose myself to that red area. And that again is just because the stock hasn't rallied enough yet. If the stock had rallied enough, just to get you thinking, okay, that means, I'm just gonna emulate it, okay? It means that 43 call, which is trading at 212, that may be trading at, 415, okay? And that 50 call that is currently trading at 0.78 may cost 178 or 175. So I'm just making up those values, but you are with me, right? Those values are greater than what we have here. And that's what happens to the calls when the stock go higher. So if the stock go higher, you will get greater values. And if the values were greater, so now the risk profile, look at that. Okay, not yet, but almost, okay? So you will still lose $15 if the stock gaps up 20%, but you get the point, right? So if the values were just a little higher, okay, just a little higher. So let me make this to be, 5-1. So if the value was just a little higher, notice now how the upper part of the butterfly is a profit no matter what. So if the stock gap's 20% up, you're gonna make less, but at least you profit, you don't lose. Okay. So just too soon to do the conversion, and therefore Yelp is a trade to be left alone for now. Okay. So we're gonna leave it alone for now, and we will reevaluate that later on. Yeah, that's it. So that takes care of the review of the trades, and therefore we got 15 minutes of time, and I would like to go ahead and find a long. So tomorrow maybe we can start looking at shorts first, and hopefully non-directionals too. So let's go for it. Any question, everybody? I'm gonna take a sip of water if you don't mind. So let's go for it. Okay, so we are looking for longs. Okay, so first thing is that we want the positive CIV spread out there. For now, the implied volatility, I'm just gonna say I don't care. Elliott wave turning points for now, I will uncheck. Then I'm gonna be looking at groups to be long-term strong. Scan list, let's import the penny increment options list I always use. You don't need to use that list, okay? But again, it has its advantages, so that's why I use it. Again, on this section, nothing. Earnings, we exclude anything that reports earnings in less than 30 days, just to give ourselves time to reach a target. And then from an auto climate point of view, we're going to be looking at climates to be confirmed up, sensible, with a weekly climate to be confirmed up, ideally early, and ideally we are near the 9 EMA on the daily time frame. So again, that's very demanding. Often we get no results or very few. Today we got no results. So what if I don't demand being near to the EMA? We got one KBH, funny enough, because that one is a one that is short. And by the way, notice what just happened here. KBH used to belong to a short industry. Well, that's a great finding, to be honest. Maybe we could have looked at the chart, and that would have been a good comment coming from me if I had done that. But anyway, we see it here now that we said KBH didn't work well as a hedge. And one of the reasons why it didn't work well is because KBH used to be a stock that belonged to a weak group. And guess what? That group, that sector of the market now is strong because our filters are looking for strong. So probably it's not like that stock went to the moon. It's probably the fact that that stock used to belong to a weak industry now belongs to a strong industry. Okay, so hey, that's what happens. We got a sector rotation scenario, in this case, impacting the result of this trade. So anyway, so now what if instead of looking at confirm up and early, we look at up and sensible? So now we have FCX, okay, and then I'd be happy to begin the analysis exploring that one. Okay, so let's take a look at FCX, okay, and see what is it that we have. Well, FCX, to be honest, is right there where the EMA is. Okay, so all of this is cool. We're in a climate which is 4 out of 7, so I'm very happy about that. The average put, it's about the average call. That's not good, but today, because we have it in the filter, today actually the calls are above the puts. Okay, I like to see the average to be above the put. It gives you a bit more strength, if you wish, or a bit more confirmation. The reality is that we don't have too many stocks to choose. So what I'm going to do is choose from. So what I'm going to do is I'm going to look at the options volume map to see what I see. And what I see is indeed not significant, because while we have many more calls traded than puts, none are above the triangle, which is the average. Okay, none. So I'm not impressed. And because the average implied volatility for the calls is below the average implied volatility for the puts, I'm not impressed. I'm not going to go with it. Okay, I'm not going to go with it. And maybe tomorrow, now the calls are above as an average, and then that's a different story. But today I would not go for it because of that one reason. Okay, when I'm directional, it's either I want to see a stock which is healthily moving higher or likely going to move higher, or I just want a stock which is just crashed so much that a turning point is so likely. Okay, but when I see that, that's a concern. And if the volume map was to say otherwise, then it's a different story. But like this, I'm not gonna go for it. So what else? Okay, well, of course, if I go for hopeful, that's a bad idea. You don't want that. Okay, you don't want that, and therefore my only choice, okay, here, if I want to continue working with AutoClimate, is maybe to vary from daily to 2-day, okay, and see if by looking at the 2-day time frame I get more choices. And it seems that both with the daily and the 2-day I end up with the same choices. So my last selection will be 3-day, and I also get the same choice. So in other words, if I uncheck weekly and I go back to daily, I am pretty positive I'm gonna get more. Here we go. But the problem is that I'm pretty positive too that all of those are probably in a hopeful situation on the weekly time frame. You see, now if I add hopeful, I get some of the symbols that were there before. So in other words, I am not happy about trading in a condition where one of the climates is hopeful, because while something that is not likely to continue could continue, and we saw that on the S&P, the reality is that it's not likely, and therefore I don't want to start a trade with the word likely against me. Okay, so not happy to do that. Then my approach then would be exactly the same that I had in the prior cases last week when we were looking at Yelp, where I also looked into, so what if instead I'm looking at markets that are going down, and they are very late, meaning that they've been crashing like crazy for a long time. So what if we were to do that? Okay, if we were to do that, we end up with two different symbols. Okay, we end up with two different symbols. And now, to be honest, in cases like this, what I would like to see, like we've seen before, is I would like to also add my speed bumps of support. So stocks that have been dropping a lot, okay, not only they've been dropping a lot, and from a climate point of view, they are very exhausted, but on top of that, they are inside of a speed bump. Okay, now what's my issue? My issue is that, there are none. Okay, and this is because the S&P has started rallying higher. Okay, so I'm finding a very similar situation to what I saw last week, and therefore my choice number 3 is to get back to my DT tab and now rely on Elliott wave in order to find those entry points. So I'm going to go back to top positive spread. Okay, and now I'm going to be looking at Elliott wave turning points in the last 5 bars, and well, we got Yelp. Okay, so that's it's good to see. I mean, we know Yelp got that Elliott wave turning point here. I believe that we saw that. Yeah, I believe now for sure we saw that last week. So he's there, but we got this one already. So then instead of looking at the long term, certainly happy to look at medium term, including short term. Okay, I would not go as deep as ultra short or dynamic, but if we look at medium term, happy about that. So let's see if we get any result. And in this case, we got a few more. Okay, so we got Valero. They're all technology. They're all energy companies. Valero, Cheniere, and ConocoPhillips. So let's take a look at those and see what the charts have to offer. Okay, so here is the Elliott wave turning point. Okay, not looking too good because it seemed that it was going into a climate, but then it didn't. And on top of that, look at the implied volatility for the puts. So not too happy about that. What if we look at LNG? So LNG is looking so much better. The implied volatility for the calls is above the implied volatility for the puts, and the climate is defined. That is not too common, especially when you look at the Elliott wave long term. But with the medium term, sometimes you'll get that. You get the climate in your favor, and on top of that, you got the Elliott wave. So it's good. So we have that option there. So now the only thing I need to find out, because from the technical point of view, I am indeed inclined to get long that stock. So the only thing I need to find out is, do we have UFOs lining up with the EMA located at Current value for the EMA is currently 105.46. So do we have that? We do, but probability is not good, 43%. So if the 55-minute time frame doesn't give us that, what about the 89? So the 89-minute time frame, you guys have been very quiet for a long time. I know I keep going, but please talk to me. How is it going? So we also have a UFO there, perfectly located, but again, 45.92 is not good enough. So what if we go to 144? Still not good enough, 47%. What if we go to 233? Joanne, listening, thank you. Okay, just loading the 233-minute time frame. So downloading the data. It's going to be on the screen in just a moment. So that's still 45. And therefore, I would guess that 377 is not going to be that different. So we're gonna look, 38%. So not good. The intraday time frames for that stock, really those orders get canceled all the time. So not ideal. On the daily time frame though, we got 53%. But that UFO is located at 103.95, which is too low. It's not lining up with the EMA. So not happy about that. Same with the 2-day time frame, and same with the 3-day time frame. Okay, so interestingly enough, it was looking very good, but we don't have the UFOs. Okay, so we have the indirect force, but we don't have the direct force. Okay, we need to pair the two of them to be in a better position. Okay, so let's take a look at COP, ConocoPhillips. Maybe that one will be a better choice. In this case, we are in a down climate. Okay, not too concerned because again I'm relying on Elliott wave. Okay, and also it's 5 out of 4, so that down climate is quite exhausted. It's supposed to start going up. Okay, the implied volatility of the calls is above the implied volatility of the puts, and that stock belongs to a strong industry. So all of that I'm fine. Okay, now of course because I am below the EMA. Then my reference for an entry would obviously not be the EMA. Okay, it will not be the EMA. And I'm just going to be looking at the charts and see what the charts have to offer. In this case, the 35-minute time frame is providing 36% probabilities. That's too little. What about the 89? $43. What about the 144? Do they work? Here we go. So I'm just going to save a little bit of time and follow you, Christian. We go for 2-day. 2-day is 58%. Very good. That's exactly what I needed. Okay. So this is exactly what I needed. And now what I'm going to do is because I am below the EMA, okay, because I am below the EMA, I cannot pick UFOs which are lining up with the EMA because I am below the EMA, right? Unless I wait for the climate to change. Okay. And if I wait for the climate to change, well, that's indeed a very valid approach. Okay. But that means that then, why did I scan for Elliott wave, right? I just wait for the next day and then scan based on the auto climate. You know what I mean? So in this case, when we have the Elliott wave turning point, so that and the fact that the climate is exhausted and the fact that the sector is strong, all of these should help the stock to go back to where it needs to be, right? So I'm okay with getting in, but the way I'm going to get in this trade is just the same, exactly the same that we did with COF. Okay, I'm not going to do it like what I've done with Yelp. I'm going to do it the same way we did it with COF, which is selling puts below to pay for the calls we're going to buy above. Okay, that's what we're going to do. Now, if we do that, what target are we shooting for? Okay, and I'm just going to place my speed bump out of this particular high, and that means that the target we're shooting for is 79. Okay, 79.30. Okay, 79.3. So that's the target. Now, for me to reach that target of 79.3, okay, 79.3. So how long is it going to take? So let's do an estimation, and that would be Santa Claus Day, okay, 24th of December, okay? That would be the day when that target would be reached. Nice gift for Christmas. So with that date in mind, let's go back to the daily time frame so I can check the earnings. The earnings for this trade are supposed to happen in February 1st. Okay, so then I'm gonna have to rely on the February expiration date, even though we expect to reach the target in December, but we're gonna be using the February expiration date, for this trade. So let's do that. Let's do that. So what if we are looking at February 18 expiration? So first of all, liquidity is pretty cool, which I'm not surprised, and it's a monthly expiration date. That's fine. And okay, so we have the option chain in front of us. Now we were relying on the 2-day time frame to put this trade in place. That implies that we have this particular 68 UFO there. If I project a speed bump below that, that speed bump will be located before that. So I feel pretty confident that using that 69 UFO is probably a powerful thing to be done. So let's see. If I look at, we said 69, right? So 69, let's rely on the 67.5, if that's okay. 67.5 is somewhere in the middle of that UFO. So we're going to rely on the 67.5, and therefore the next strike below is 65. So we're going to have $250 of risk per bull put spread, and we're going to have to take 2. So it's going to be $500 of risk this trade. So let's go ahead and create this trade. So we're going to be using February 18, and we're going to do 2 of selling the 67.5 put. Okay, we're going to do 2. Then below that, we're going to buy the 65, which is the nearest one below. Okay, so if I do this, right, and I show you the risk graph, so as you can see, the maximum risk of the trade shows us 345 because, you got $500 of risk there minus the credit collected 155. So that's $345 of risk. But again, now we're going to use that credit to buy a call. So then your risk is going to be around, as I was saying, $500. So what kind of a call can I buy? Let's load more strikes. What kind of a call can I buy with 155? Actually, let me do this. I want to reclarify something important, guys. If I do the bull put spread 1, you get 0.77. Okay, 0.77. If I do it twice, okay, if I do it twice, that's how you get 155. Okay, so the total is 155, but because you do it twice, okay? So don't be confused there, okay? So with 155, I could go ahead and buy the 85 call. That will cost me 150, okay? So if I buy the 85 call, one of them, not 2, okay, that is going to basically be a 26 cent credit trade with a 33 positive delta. Okay, so if that stock starts rallying, I'm going to start picking up profitability. If the stock drops, of course, I'm going to lose. Now, what's the most I can lose? Well, $474, which is what I was saying was going to be around the 500, isn't it? Now, if the stock rallies, okay, we're going to make so much more. What was our target? Our target was going to be located right here. We said 79.3 exactly. So 79.3 is about here, and this is very disappointing. We are not picking up enough deltas here, so we are not going to take this trade this way. Okay, so if you reach the target, you will be making $26, and that's because the 85 call is way far out of the money. I was not noticing it was so far out of the money when I was selecting that call. But I cannot select another call, because if I select a closer call like the 82, the 80, the 77, it's going to cost me $3, $2, which I don't have credit enough to pay for that. Okay, so it's not looking good for us to approach the trade this way. And since we reached the top of the hour, so I guess we're going to have to continue with this tomorrow. There are ways on how to move around those options and those strikes to try to make it better. But again, as I said, we're going to have to complete the session here today, given the time, and we'll continue tomorrow, okay? In any case, hopefully the rationale on how I ended up with the technicals in place, because the technicals are valid, that makes sense. And I'm just going to save my page here. So when we are back tomorrow, we continue from here as well. And then we look for more trades. Very good, everybody. Thank you for joining me today. As always, my pleasure to conduct the session. As always, very fun times for me when we get together in the room to put the trades together. Some of you sent a few emails to me during the last week and this week. Very appreciative of those emails with questions, suggestions, comments, etc. And very happy to see your progresses and everything else. So keep up the good work, everybody. Keep communicating. Use the question page as well. And see you tomorrow. Same place, same time. Take care, everybody. Bye-bye.